most of the data is pointing in the same direction, and it's not terribly optimistic. Chemicals is an obvious problem area simply because you've got this major capacity build going on at the moment because of shale gas. I think that the role of stimulus is played out. I think that China will continue to deleverage. So I'm Paul Hodges from the PH report, and we look at the world and the world economy through the lens of the chemical industry. Why do we do that? Because the chemical industry is the third largest industry in the world after energy and agriculture. It gets into every corner of the world. Everything in the room, which you'll be watching this interview, is going to have chemicals in it. And the great thing is we have very good, almost real-time data on what's happening. So our friends at the American Chemistry Council have data going back on production and capacity utilization since 1987, so 30 years of data, and we get that within around 6 to 8 weeks of the end of the month. So whereas if you look at IMF data, you're looking at history, if you like, we're looking at this is what's actually going on as of today. We look obviously upstream, as we would call it, at the oil and feedstocks markets, so we understand what's happening in that area, but we also, because the chemical industry is in the middle of the value chain, you have to be like Janus, you have to look up and down at the same time, otherwise one of these big boys catches you out. And so we look downstream, and we particularly look at autos, at housing and electronics, because those are the big three applications, and of course they're pretty big for investors as well. So there's, we see the relative balance between what's happening upstream, what's happening downstream, where is demand going, and then we see what's happening in the middle of that chain, because that's where we're getting our data from. So our data matches on pretty well, it's worth saying, to IMF data. So changes in capacity utilization, which is our core measurement. If you go back and plot that against history from the IMF, very, very good correlation. So what we're seeing at the moment, and really we've been seeing this since we did the interview in November, is a pretty continuous downturn. One would have hoped, when we talked in November, we were talking about the idea that things have definitely cooled off. Some of that was probably due to the oil price coming down. Some of that was due to end-of-year destocking. Some of that was due to worries about trade policy, lots of different things. But you would normally expect the first quarter to be fairly strong. And reasons for that are that the first quarter this year particularly was completely free of holidays. Easter was late, so there was nothing to interrupt you there. There was the usual Lunar New Year in China, but that always happens, so there's nothing unusual about that. And normally what happens is that in the beginning of the new year, people restock. They've got their stocks down in December for year-end purposes, year-end tax purposes. Now they restock again, and of course they build stock because the construction season is coming along in the spring, and people tend to buy more cars in that period, and electronics and so on. So everything in the first quarter was very positive. And one wouldn't normally be surprised to start seeing stockouts in the industry, particularly after a quiet period in the fourth quarter. And unfortunately, we haven't seen any of that. We've seen, and this is worth thinking about for a moment, we've seen a 25% rise in the oil price because of the OPEC-Russia deal, but we haven't seen the normal stock build that goes along with that. And just to explain, this is a bit counterintuitive. When the oil price goes up, people in the chemical industry know that the prices of chemicals is about to go up as well, because oil is so important and so is gas. So they tend, we're sitting in April, they will tend to say, oh look, the price is going up, we need to buy in April because the price in May will be higher. And now that should have happened, but it didn't. And this is the first time I can ever remember that not happening. And the only reason that one can come up with for that is because obviously interest rates aren't high, so finance directors wouldn't be saying, oh, no, we can't afford that, can't do that, or anything. It can only be that end user demand is actually quite weak. And so the sales team are actually saying, we've got quite a stockpile already, we probably don't need to add to it. So That's where we are at the moment. What we were talking about at the back end of last year, that the smartphone market has gone into recession for the first time. So clearly that trend, which was very, very powerful over 3 or 4 years and followed on from previous trends, has now run its course. And there isn't actually anything else that we can see coming along. And what we are seeing, everyone will notice this, that orders from Apple and so on into China are weak, and we're getting adverse reports coming out about future market demand there. When Apple said last year, "Oh, we're not going to publish our sales figures anymore," not usually because they're so good that people might get too excited. So something has clearly happened there, and we've seen that since. If you look at autos, we follow the top 7 markets, and which are sort of 70–80% of the total. And of those, only one was up in the first couple of months this year, so Brazil. All the others, China, the States, Europe, Russia, India, so on, and Japan, they were all down. Some of them not by very much. China down by quite a lot. But so there isn't anything out there that says, well, wait a minute, this means you might be at a turning point. For the moment, most of the data is pointing in the same direction, and it's not terribly optimistic. When we saw the lending numbers for January, it was understandable, I think, that a lot of people jumped to a conclusion that said, stimulus is back. And there's absolutely no doubt that if you look at what happened after 2008, if you looked at what happened after 2015, both times the Chinese government was panicking for certain reasons. So it was panicking because 24 million people were unemployed after the financial crisis, after Lunar New Year in February 2009, massive stimulus. Again, not quite panicking, but wanting to bolster the position because you had the party congress coming up and the reappointment of all the top officials, and you don't want any unrest or disturbance ahead of that in 2017. So, and I think the markets were absolutely right at the time to say, well, we're going to see a big increase in consumer spending and so on. So all of that went through. We've had a record level of lending, not so much in February, but you take the first 2 months together, and you have to do that because of Lunar New Year, otherwise comparisons are meaningless, but you do that. So yes, it was definitely a record level of spending, but we have also had auto sales, housing sales, and smartphone sales. And auto sales are down, and that continues after 2018, which was the first year that the Chinese auto market had been down since 1990. So this is a big break going on here. And sales are down in the double-digit numbers. Similarly, in smartphones, sales are down in double-digit numbers. In housing, we don't have such detailed data, but China Daily, the state-owned media, reported that Evergrande, which is one of the big 3 property developers, in January and February saw its sales down 43%. Now, and they weren't reporting that as an exception, they were reporting that as part of a downbeat thing about housing. So it really does look to us as if the consumer market has turned down here. Please don't get me wrong, we're not talking about the collapse or the implosion of the Chinese economy or anything like that. We're talking about a restructuring of the economy here, I think, that's going on. And one does have to distinguish between the very wealthy parts of the city, the very poor parts in the West, where there are still 80 million people in China living on an income of below poverty level, below $2 a day. Still 80 million. So we can focus on the skyscrapers in the Bund in Shanghai, but there is another side to the story. And I think that the Communist Party is trying to redress some of that balance that's going on. But the other thing is, where has this lending gone then? And again, we're searching for answers a bit, but we do have data about industries like China Rail, where we know that their interest payments have been larger than their income since the data was published, since 2015. We know that as part of the stimulus program this time around, it's more focused on infrastructure, and we can see, therefore, that if they already have a major 5 trillion renminbi debt, that this is going up, and that probably they're unable to meet interest payments going forward, and therefore they need support. Similarly, one of the big areas of concern, and we're not the only ones who've focused on this in the past, of course, is the local government financing vehicles. And the issue here is that local governments tend to get their money from property sales. So the Communist Party owns, or the government owns all land, and so if you want to make your numbers in the local region, you sell land to your friend, the developer, and he then pays you some money, which goes into your coffers and boosts GDP. He then builds some housing blocks, and again, you get some revenue from that. And so if the housing market is slowing down, that's when local governments start to run out of cash to pay their bills, and particularly these off-balance sheet local government financing vehicles. So it looks to us, we may be wrong, but we've been looking at this a long time, looks to us as though the stimulus money hasn't gone to spark new consumer spending as one might have thought as before, as markets seem to have assumed. It's actually gone to meet these headwinds that you get from debt. Because after all, at the end of the day, what does debt do? Debt brings forward demand. I can either wait and save up and then buy it, or I buy it today and pay it back afterwards. Either way, it's the same thing. I don't need two cars to drive at the same time. And so it looks as though this is what's happening, that we're getting these headwinds coming through. Again, please be clear. I'm not saying the economy is imploding or anything like that. I'm just saying there is this necessary restructuring. And it's very sensible for President Xi in his second term. He had to, he wasn't in charge of the economy in the first term. It was Premier Li who was doing the stimulus and so on. Now he's got it himself. You have to do that at the start of your term. You don't want to be doing that in 3 or 4 years' time. You've inherited the position, you now deal with it, you take the pain and move on. And of course, President Trump is providing him with an ideal excuse that we have to tighten our belts because we don't know what the Americans are going to do. We see it in two areas, and the more areas we can see it in, the better, really, of course. So we've seen the downturn take place over the second half of last year in chemical capacity utilization. And this isn't because there's been a massive amount of new ahead of demand, it's just that the demand is not being used. Then, of course, we can talk to companies, Chinese companies and Western companies, and get an anecdotal view from them, which is usually pretty reliable too. So there's that. But then if you look at some of the basic chemicals that are around, things like acetone and so on, you can see, and we have data for these storage and so on, and these are at record levels. So there is a consistent picture here that within the basic chemical market, there is not a lot of strong demand, that production is ahead of demand, and that stocks are building. If we were going to be consistent with our story, then one would have to see a downturn in Germany, because obviously the German economy has been heavily dependent on export sales to China, far more than anybody else. And yes, indeed, we are seeing that. And we've just seen, very recent data, which all of the major economies in terms of chemical production, so Germany, France, Spain, so on, are down with just one exception, which we can come to in a moment, and they're continuing to go down. And so what does that mean? Well, if Germany is the motor of the European economy, and if the motor was firing on all cylinders when stimulus was underway and China was going strongly, well, if the motor isn't going to fire so strongly, then when China starts to slow. And that's what we're seeing. It's very hard. You've got an aging population, as we know, across Europe, particularly in Germany, median age of 46 or so. And Europe has not replaced its population since 1970. So we're coming up to 50 years of not. So the number of people in what you might call the wealth creation age group, 25 to 54, where people will tend to sort of start their careers, their salaries will move up, they'll very often settle down, perhaps have children, they'll buy houses, they'll buy cars and so on. There's a relatively small number of people in that group. And of course, we've got this older group, the perennials, if you like, who sort of, unfortunately, from an economic point of view and from a central bank point of view, instead of getting their gold watch or their clock and retiring and dying next week on the golf course, as they should have done, they're actually living now for another 15 or 20 years. But they're not economically active. And you look at spending across the world, for people aged sort of 65 to 75. By the time you get to 75, it's half the level of when you're 45 to 54, for very obvious reasons. So you've got these two big headwinds in Europe, where, as you do, of course, in Japan, where you have the problem of an older perennial generation that really isn't contributing very much, and a relatively small wealth creator, 25 to 54. So all of this is very consistent. What would have made the difference? Well, obviously, China doing what it did made a fantastic difference, but if China is taking its foot off the accelerator, well, Europe is now going to have to face those issues. And I did say there was only one country that didn't buck the trend, and that, of course, is the UK, where everybody had feared that we might have fallen out of the European Union, already. We've now got till April the 12th before we fall out. Maybe we won't, who knows. But almost every company that could has stockpiled. We talked to a lot of people, and every warehouse in the UK, every village hall is stacked full of stuff. I mean, the car companies are right, unfortunately, in the middle of the storm, because they've all decided to bring forward their summer shutdowns to this fortnight in order to avoid the worst effects if there was a no deal. Well, of course, there isn't a no deal, so they could have been running normally. Now they'll be coming back, and if there is a no deal that starts on the 13th of April, they'll just be this is not very clever. So, but anyway, if you build stockpiles at this extreme level, you can either assume that Brexit is going to be the most wonderful thing for the economy and we'll never see a downturn again, or you say, well, it's going to be a pretty rough second and third quarter because we're going to unwind it all. I know where I put my money. We tend to look at these things, and I suspect a lot of people do, in terms of, what's the trend going on here? Are we going up? Are we going flat? Are we going down? And what is it that's going to come along? I mean, if you like, what we've done is we've talked about the why we might be going down and the what, in terms of how we see it, in terms of the end user industries, chemical industry, and so on. So now you get on to the interesting question of how and when, which is where you can make or lose money. And and I've been an oil trader, in Houston, Texas. So I'm pretty keen on the how and when side of this rather than just the high level analysis. And so one's looking at indicators to see whether the downturn becomes exponential, if you like. And the oil market seems to us to be playing that role at the moment, in that, and I'm not making any sort of great claim, I'm just saying, we're in one of those moments where the oil market is clearly going in the wrong direction compared to supply-demand dynamics. Saudis cutting by 1.2 million barrels. The Russians are cutting a little bit now and again, but of course it's very cold in Siberia, so you can't, who would have thought it would be cold in Siberia? The usual excuses from everybody else, but the Saudis, as usual, also are picking up the slack. And they want the $70 a barrel price because they've got some very extravagant budget needs to restructure the economy, so that's what they want. And the problem, of course, is that if the market now starts to fall away, if Chinese demand really does continue to slow, and if India continues to slow, well, what are you going to get? Those are your two main sources of growth for the oil demand. We do know that Saudi is not the swing producer anymore. We know that the US is now the largest producer. Russia is up there too. I'm very happy to discuss it with anyone, but I don't believe that Russia will ever cut back meaningfully. They've never done it in the past. They'll never do it in the future, in my view. It doesn't suit their strategy at all, but they'll talk a good talk. So you've actually got more and more oil coming out. Some of that has been delayed in the States in terms of hitting the market because of infrastructure. Shale came out so quickly that the pipelines and everything just couldn't get there in place, but they are coming in place. So the answer to your question, what would I see as being a catalyst for this, is the oil price. If the Saudis can continue to hold it at around today's level, and maybe they have to cut some more and so on and so forth, then you probably say, okay, it's not looking great. But on balances, this is happening there and that's happening there and so on. Okay, we've got to wait for a catalyst, which could be up or could be down. If, however, and this is, if I had to have a base case, that this is what I'd say. If, however, towards the end of sort of the quarter, we start to see that oil price slipping, then I'm saying, we could well be into that period, because once you go past the driving season in the States, and the driving season ends, as far as the refiners are concerned, on Memorial Day at the end of May. Because you've got to have your oil through the refinery and out through the distribution network in order for when people get in the car and start driving to the Grand Canyon, that it's there. So driving season, end of May up till July 4, carries on a bit after that to September. But if you see a collapse in oil prices, it tends to come about that time. So if China isn't picking up the slack, if we're not seeing a strong recovery, and if the States is starting to come out with more and more oil, which it will do at these prices, very profitable to be producing oil in the States at these numbers, then that will tell us that we're on the way down, which is where I fear that we're headed. You could almost see it in two stages. So you could see that oil demand growth is not surprising on the upside anymore, which is why OPEC and Saudi are having to intervene in order to take product off the market. So that tells you first things are not as powerful and strong as people think. The second thing, of course, is can they maintain that position given what is going on in the rest of the market? And this is then, we may come back and talk about this another time. If we look at producer price inflation in China, it is touching zero at the moment. And it's really, if it wasn't for the swine fever problem in keeping pork prices up, it would probably be negative. Now, China is still the manufacturing capital of the world. Now, if you put together I'm saying if, I'm not saying when, if you put together a resolution of the swine fever problem and therefore a move by China into deflation, together with a fall in the oil price, you will have deflation across the Western world and across the main economies. And you will have that as you go into the end of the year. So, and there'll be nothing that the central banks can do about that. So all this 10 years of don't worry, we've solved the problem, unfortunately, their credibility will not be that high. Now, I don't think they'll stop. I'm sure we'll get helicopter money. I'm sure that's what we're talking about with modern monetary theory and so on. But that, to me, as somebody who deals with the nitty-gritty of what's happening in the markets and how much are people actually buying and selling things and services and so on, because we cover services as well as goods, so we cover the whole piece. If that starts to happen, then I think we've got a serious problem. Chemicals is an obvious problem area simply because you've got this major capacity build going on at the moment because of shale gas. Essentially, you have to extract ethane from natural gas if it's wet, as it's called, because otherwise it goes into, if you keep ethane as high quantities over 3 or 4% in the natural gas steam, it gets into the condominium in New York. You light the oven or the hob and it explodes. And, guys, the East Coast are really, really fussy. And they don't like that. So you have to extract it because of that. What else can you do with it? Absolutely nothing. You can only make ethylene from it. Therefore, you can only make polyethylene and so on. So you're getting this wave of new capacity, which is really distressed product. Got nowhere else to go. And there's almost no way that it's going to stop because the economics of closing down a gas well, you'd have to have a price of minus goodness knows what. Nobody would ever do it. So it's going to keep coming. And of course, if it can't go to China, which was the original idea, because demand is down and because you've got 25% tariffs and all of these things, where else can it come? It comes to Europe. And so from a chemical industry point of view, we are seeing major price wars starting to develop now. And companies like Dow are issuing profit warnings and so on because of this. So that's that I'm afraid is already part of the landscape and priced in. I think the other areas obviously people are hoping that the oil price will move up. Capital goods, of course, as you say, will be will be affected if how much more investment do we need if we've already got too much? These are the kind of questions that we're starting to think. But autos is definitely autos for us has been a sell for about 9 months now or so. A, because we think that new car sales are coming down. B, because of the enormous investment needed for electric vehicles. And 3, because we've had such boom conditions over the past 4 or 5 years that the second-hand market now, the used car market, is looking extremely attractive. I mean, if we talk about China, for example, if you go back 10 years, there wasn't a used car market in China because the cars didn't last more than 3 or 4 years. They were all Chinese built. Now, they're still not coming up to the 11 or 12 years that you expect in the States, but they're coming up that way. And there's a very strong... So the used car market in China last year grew at 12% when the new car market fell. And there have been some quite interesting IPOs of people like Yushin and so on, which are putting together, rather than your old second-hand car dealer, yeah, come on, Gov, I've got this lovely car for you. Oh, yeah, right. Yeah. You've got online with insurance, with guarantees and warranties and so on. So a completely, much more sophisticated kind of thing. And of course, this does key in with government policy because people are not going to be able to afford a new car in some of the poor areas, but they could well afford a used car. And that would be a tremendous bonus for people in the poorer Western provinces. And so the government has been removing the barriers on moving cars between the provinces, from the rich to the poorer countries. So it's taken some time, but it's been done. So we can see good growth in the second-hand car market. And that's the thing, we're almost... And I'd hesitate to get too excited about this, but we're almost getting to the point where we're moving beyond all assets go up because central banks pump out large amounts of money to stock-picking kind of markets. And actually, that market is going to do really well, almost whatever happens. We're at the point, as we were saying, where the market, I wouldn't say it was balanced at the moment, I would say it's trending downwards. And therefore, it's quite vulnerable to something that will push it over the edge, if you like. One of the things that, of course, is quite worrying is that the central banks are still trying to interfere in the workings of the market, and therefore they're producing very distortionary pictures. So the stock markets are going up, when in the real world, things are not doing that well. Maybe the stock market is leading indicator, maybe all this is falling. I don't believe that at all. I don't think most people believe that. It's just that, Powell decided that he was going to, stop quantitative tightening. And so everybody says, oh, don't worry, we're off to the races again. I think that the role of stimulus is played out. I think that China will continue to deleverage in a kind of sensible way over the next year to 18 months. I think we will see areas where we have to look at things in more detail, like where is the money going that they lend? Is it going to pay off debts, or is it going for new spending and so on? And I suspect that's going to be a trend that we're going to have to look at. We haven't talked today about corporate bonds, but if you want something that I think could blow up quite nicely in the second half of this year, it's corporate bonds. Because if I'm right about deflation, and if I'm right about the potential for earnings to decline, then that sort of near half of bonds which are triple B could easily get downgraded to junk, and we know that many investors can't hold junk. So, but we're not there yet, and there's money to be made no matter what. As long as I would use this time to think clearly about where might we end up in 18 months' time, and what would I do today if I thought that was going to happen.